I'm going to tell you, if the Fed decides to pause, we are done. And you look at the fact that the market still has a lot of easing priced in. Even now, we're going back to 5% of the 10-year note. And I hate to say it, I almost choke when I say it. Right now, I think the odds of a clean sweep by the Republicans higher than a clean sweep by the Democrats. Well, we get a clean sweep by the Republicans, I will very quickly pull the plug on my bond call. Like right now, I'm a nervous bull on bonds. Nervous bull, but I will just have to take the bull out of that title. What did I see in the Financial Times? I mentioned today what the global public sector debt is heading towards $100 trillion. Hello? 100 trillion.
Does the bear still roam? Hi, everyone. I'm Maggie Lake, and I'm talking macro today with David Rosenberg, founder and president of Rosenberg Research. Hi, David. How have you been?
Not too bad. Maggie, you caught me in my cave.
I know, and
But
I'm teasing about that name, and we'll discuss it in a little bit. But
it's great. It's great to see you again.
yeah, same here. But we do know. Listen, you and I have talked, and I know that you've had concerns. You're doing well, and I'm glad to hear that. What about the U.S. economy? Because you've been worried about the outlook. You've kind of been, a contrarian, thinking that things were weaker than everyone else. So,
Yeah.
What's your view right now?
Well, it's absolutely incredible how solid the U.S. economy has been. I would say depending on the metrics you want to look at, of course, we all bow down to the holy grail of non-farm payrolls, which have only been revised lower in the past year, 75% of the time. But the employment side, at least on that survey, less so in the household survey, and we've seen cracks emerge in the JOLTS, and even in the ADP, small business employment down 2 of the past 3 months. But, we all trade off of and all focus on the non-farm payrolls, and they've been remarkably strong. And then we go to GDP, and it just seems like just press a button. It's like 3% every quarter. It almost reminds me of the old days with China. Just press a button, it's 10% every quarter. It's surprising because when I look at the high frequency data, for example, industrial production, basically, actually, it's not even flat year over year anymore. It's slightly negative. Retail sales volumes, basically flat. Auto sales year over year, basically flat. Real core CapEx shipments and orders, year over year, basically flat. So we know we've got this AI boom going on, but it looks as though overall, in terms of the business sector, AI aside, there's no real CapEx cycle going on. So I'm looking at all these high frequency numbers. So home sales, both new and existing together, are running negative year over year. But basically, when you amalgamate all the incoming monthly data, they're running basically flat on a year over year basis. So I guess maybe we're in a new era. I hate those two words, where flat is the new up. But GDP is GDP. So, what's going on here is we've had tremendous ongoing stimulus from the government sector, and not just federal, but also state and local, which seem to be using up all those rainy day funds, all that cash transfer that they got from Uncle Sam, along with everybody else during the height of COVID. So we've got a few things going on. We have tremendous government stimulus, like I said. I was not anticipating, Maggie, when we spoke last year at Lisbon and you interviewed me, I was not anticipating that we were going to take a $1.7 trillion deficit and turn it into a $1.8 trillion deficit, over 6% of GDP for the second year in a row, boggles the mind. When you look back historically, 6 decades worth of data, historically, when the government was fighting a recession, that deficit GDP ratio would be 3 to 4%. That's what it would get to stimulate the economy and fight the recession. We're now over 6%, and there's no recession. But that's been a primary source of support, especially when you count in all the indirect impacts, all the multiplier effects that come from all that government stimulus. Of
Yeah.
course, we have this other situation, which we can talk about more in depth when we talk about the stock market. But the
So
symbiotic,
let me jump in. Let me jump in for a
sure.
second because I think this is important because it sounds like so are you I was I was kidding about being a bear. Are you more bullish now? Because I know you've told me you're not a perma bear. You know, you
Uh,
just talk about what you see. Are you bullish or are you just saying that that fiscal extended this economy was more supportive than you'd anticipated, but you're still concerned? Sort of
well, you
walk
know,
me through your mindset right now.
well, look, I was. I feel like I'm in suspended animation. You asked me, am I bullish or bearish? I know those are terms people like to throw around. I'm certainly less negative than I was. And I had these similar conversations back in, you know, early 1990 and again in, the fall of 2000. Had the same conversations we're having right now throughout 2006 and into 2007, where you feel almost if you've been bearish on the economy, that you're in purgatory. And so I don't know if I'm bullish or bearish. I've been, again, to a fault, which is my nature, way too early on the recession call. There is no recession right now. But what I'm trying to do, and it's less having excuses about being wrong, but more trying to explain the situation
Hmm.
and where it was I got wrong. Now, I've been in this business for 40 years, and frankly, I've never seen such wide dichotomies, as I said, between the high frequency data and GDP.
Mm.
But everybody is focused on GDP. Now, we get a good retail sales number for September, okay, and we got a pretty bad industrial production number. So the product side of the economy is actually in contraction. It's not the overall economy, and we know that we're more service driven than goods driven. However, there are wide swaths of the economy that are in varying degrees of pain. The
Hmm.
housing market can't get out of its own way. The commercial real estate market, the industrial sector is actually in a recession. And then there's other things that are booming. And we have 10% year growth in government expenditures. Government sector is booming. In the household survey, the government featured extremely large. We had 785,000 government employment increase in the household survey in the month of September. Those only surpassed in June 2020 when everybody was returning back to work. And without that bulge, the unemployment rate would have gone to 4.7
Mm.
instead of going back down to 4.4 from 4.5. So I'm not trying to explain everything away, but if you're going to ask me if there's a certain degree of confusion, yes, there's just a wide dispersion between all the incoming data that are running flat to negative year over year. And that's why you have to look at these indicators because there's month to month noise. The year over year trend, if I showed you all the year over year trends, if I had my slide package right now, Maggie, you'd be thinking that does not look like 3% GDP growth to me,
Yeah.
but that's where GDP is. But you see, these numbers I'm talking about don't include government. Uh, I was really struck. I was not expecting the economy to be this strong or to be construed as being this strong when the latest Fed Beige Book came out. Now, the Beige Book is not a piece of data, but the Fed's been releasing it since 1970. Used to call it the Teal Book, then it became the Tan Book, and now it's the Beige Book. So it's very colorful. And the one that came out that went into September showed that three-quarters of the U.S. economy is either in stagnation or contraction mode. And we run an AI model, so I've invested a lot in data science. And this was the same beige book that we had heading into the previous four recessions.
Mm.
So it's a little astounding. Now, people say, okay, but the beige book is just a book. However, I would say that it is the most comprehensive and informative piece of anecdotal evidence as to what's happening across the U.S. economy in terms of regions and industry. And it doesn't get revised. But you see, the Beige Book has the Fed staff in the field interviewing private sector economic participants. They're not interviewing government officials.
Yeah.
So I think that a lot of where I got it wrong is really two things. The first is the government part of this equation.
Mm-hmm.
Secondarily, the savings rate, although revised up with the benchmark GDP revisions, is still coming down. It's at 5%. It's half what it was before COVID, and it continues to come down. And as we saw, if you believe the retail sales numbers, remember that it coincided with pretty well flat average weekly earnings, which is the proxy for work-based income. So it's telling me that through September, the savings rate continues to come down in support of consumer spending. Well, that's tied to the equity wealth effect.
Mm-hmm.
So, no, did I expect? I mean, look, I'm not alone. Even the biggest bulls. I know that there I'm getting trapped into the labels again, but you interview a lot of bulls. But I think the consensus at the start of the year for the S&P 500 for the end of this year was 4850. We're like 1,000 points above that. I was nowhere near that, but even the consensus has been blown away by the stock market. And what happens is that, and this is where Milton Friedman cut his teeth, right? Is the permanent income hypothesis, where if economic agents perceive a shock in either direction to be permanent, it has a humongous impact on their decision making. And you see, as a consumer, 70% of the economy, every month your 401k is going through the roof. You're going to say to your spouse, honey, time to go on that vacation, or let's go to Vegas, or let's step it up and stop going to Applebee's, and let's step it
No
up.
offense, Applebee's, but yeah.
Huh?
So
Well,
it's a
so the point I'm trying to make is that that's been another very powerful impact. There's a
yeah.
symbiotic relationship. We always look at the stock market as a standalone asset class, but it has tremendous impact on confidence and spending. So that's been another part of this thing. When people say, well, Rosenberg, what did you miss? Well, I missed a few things. The government sector was one of them. The government's part of GDP. It's not part of retail sales, or it's not part of industrial production. It's not part of the durable goods orders. You look at the durable goods orders, the year-over-year trend and the core CapEx orders and shipments, you are saying, like, where is this CapEx cycle outside of AI? Non-existent. So there's all sorts of moving pieces. But, as the consumer goes, that's where the economy goes, given the dominant share. And we have a situation where the equity market is becoming a primary influence. We saw this back in the late 1990s when the savings rate kept on going down. People thought the tech mania was going to go on forever, and people felt rich.
Well,
The richer you feel, the more you're going to spend out of current income.
yeah.
And hence, that's how you get this ball rolling on the GDP numbers.
So does it feel in any way, does this composition of growth matter? So fiscal's been stronger. You can argue the AI boom, spending around that, and enthusiasm in the stock market has been longer. There's a wealth effect. Does it matter that this is what GDP is built on? Is there reason to be concerned about that? Or as long as we're growing and resilient, then that's fine?
Well, it's
is there anything inherently dangerous about the composition of growth right now?
And I'll get into that. Well, in terms of one of the key drivers, in any event, we have to respect the fact that people call it American exceptionalism, and there's precious few countries in the world that are growing 3%. It's not happening in most other countries. And you go to Canada, of course, where I am, and I look at Canada. Its economy is as big as California. And I look at North America as a continental economy. So I always say Canada is the 51st state, but with a population that doesn't, not quite as divisive. I'm not going to say necessarily you're nicer. But Canada is the 51st state. Maybe we speak French a little bit better outside of New Orleans. And GDP in Canada is running below 1%. Like
Mm.
if you talk to anybody in Canada, and we're just north of the border, about how strong things are, people look at you like you're from outer space. Canada's the 51st state. We're running less now. Why? Why is that? There's no government stimulus here. The
Mhm.
federal government, in Ottawa, is not running up the deficit spigots like there's no tomorrow. The deficit in Canada is running about 1.5 to 2% of GDP. In the U.S., it's over 6%. What happened to Ronald Reagan's famous January 1981 inaugural speech where he said, government is not the solution to our problem, it is our problem. But now, we're just salivating over more and more and more government. And here we have two presidential candidates who every week are just promising to the proletariat who are lapping it up, you know, more root beer in the water fountain. Ain't that great? No country in the world is doing this. The average OECD country is running a deficit to GDP ratio right now of 3%. It's incredible. France right now is not even running a 6% deficit GDP ratio, and they're being viewed as being in a fiscal crisis right now. Now, the U.S. reserve currency, biggest army and navy in the world, you have a longer fuse. But what I'm saying is more about, you said composition, I'm saying about the quality of the growth. This is growth that is being primarily, not solely, but primarily influenced by the heavy hand of Uncle Sam.
Mm.
And that's reverberating. So, and maybe it continues. I
Is
mean,
there
look,
fallout anywhere from that? Will
well,
there be
you
fallout?
don't
Where
know,
would we
but you
look?
don't know, you don't know about the fallout till it happens, right? We,
Mm.
we will, we will continue to push the envelope. We have to recognize the history. We're in a very precarious situation because if we do get a recession, that 6% deficit GDP ratio is going up to 10%. We're building in a situation where the deficit and the debts on the public side are becoming increasingly structural. We're heading to 130% debt GDP ratio. I don't know what the magical number is. I do not know. We know that ultimately empires and democracies ultimately failed because of excessive debt burdens. But nobody really knows in real time what is the limit. You only know when
When
years
we
from now,
reached
read
it.
the history books. Well, you'll know, for example, how do we know in Canada? Canada was playing the same sort of fiscal games, back in the 1980s and into the early 1990s, until such time as the deficit became and the debt became so structural that there was a loss of confidence, and there was loss of confidence that manifests itself two ways, which is not happening right now. The Canadian dollar went through a destabilizing decline, so there was a loss of investor confidence globally, and we had Treasury auctions, Government of Canada auctions that were tailing very badly. And actually, there was one auction in February of 2000 of 1994. February 1994. That's right. That almost a failed auction.
Mm-hmm.
And so that set the ball in motion towards a decade of fiscal restraint, where for a decade Canada became the world's poster child for fiscal probity and integrity. We couldn't have sold that story in the 1980s, but typically what happens is when we start getting fiscal sanity, it's forced on you
So
by the
this
market.
is exactly what I'm wondering, because people have been sort of mentioning signs of volatility in the bond market. We saw Treasury yields go up even though the Fed cut rates. Um, is that where you would look for that reckoning? You mentioned currency and treasuries. Is there any reason for you to think that just because the Fed's cutting rates, and or um, if they were to do that, if they were facing a downturn, the bond market doesn't have to follow suit, does it? The bond market can focus on whatever,
I'd
on the
say
debt and inflation if they choose to.
just watch the auctions. It's not about, there's yields that go up for rational reasons, and there's yields that go up because there's a lack of fiscal confidence. So, for example, you know, we went from the 5% peak in the 10-year Treasury note yield pretty well exactly a year ago, and we got as low as 3.6, and now we're at 4. Now, we're down 100 basis points from the peak, and over that time period, Uncle Sam has added more than $1 trillion to the debt load. So no, this back up from 360 to 4% plus in the 10-year really has to do more with how the markets are recalibrating their expectations of Fed policy. There's just been a re-rating. This is a mini version of what we saw in late 2023 and early 2024 when the markets front run the Fed.
Mm-hmm.
And then, oops, the Fed says we're not that comfortable. We don't have the confidence yet about inflation. And at that point, they hadn't started cutting yet. And the markets had a lot of rate cuts priced in heading into this year. And they had to recalibrate. And we had a big spasm in Treasury yields. Now, that was because we had a couple of months where the CPI and the deflator and the cores came in well above expected. A lot of that was health insurance, mostly auto insurance, and we all knew that. But the reality is that Powell came out and said, well, our comfort level on inflation just isn't there right now. And the bond market read that as they're not cutting rates.
Mm.
I mean, you had at one point Torsten Slock at Apollo saying the Fed's not cutting rates at all this year, and the market was priced whatever 150.
And then they did, and they went 50, which I think confused people. What should people be
Well,
expecting?
they did.
Now?
I don't think they confused anybody. They didn't confuse anybody. What happened was that the minutes came out for the July meeting, and we all know that the rate cut was on the table for the July meeting, but they didn't go. And then they thought at the last meeting in November, well, we should have gone 25. We didn't. We're going to go 25. We'll put the two together and go 50. They didn't do anything wrong. There was nothing bizarre. You've got the Fed funds rate is still basically like over 200 basis points above their own estimate of neutral. Even if you think neutral's 4, which I don't, we're still so they didn't do anything wrong. They played a little bit of catch down on rates premised on what they thought they might do in July, but they didn't. So big deal. It's not going to, when you're taking a look at the average interest rate out there that households and businesses are carrying, it's more than 200 basis points below where the spot rate is right now. So the Fed's got a long road to hoe. It's just they don't have to be that aggressive, and they may even pause based on the current data. But interest rates are cyclical. So why would anybody, given what the data have shown, 3% GDP, Atlanta Fed at 3% yet again, ripping non-farm payrolls, unemployment rate went down, didn't go up. And the Fed is talking less dovish. They're not saying they're not going to cut rates, but the market was pricing in a lot just about a month ago. So it's just basically about recalibrating. None of what's happened has anything to do with deficits or debts, but it does have to do with the fact that to justify where yields were at 360, the data would have had to deteriorate a lot. Now, the inflation data to me have been fine. It's not about that. It's basically interest rates have a cyclical component, and the economy is not falling off a cliff. At 360, I'm not saying necessarily pricing in falling off a cliff, but at 360 in the 10-year note, which is where we were not too long ago, you're pricing in you were pricing in a 3% GDP growth world.
No.
Now, what I refuse to do in answer to your question is I'm not going to extrapolate what's already happened into the future because I don't know how much of this is recurring. Like, for example, tons of fiscal stimulus, but I don't know what's going to happen next year if we get a divided Congress. I am thinking that we're going to get a split between the House and the Senate. So in some sense, it doesn't matter despite
You don't think there'll be a Republican sweep?
I'm starting to think, I'm glad you asked that. Things have started to change. So I think that, but they're changing. Well, there's only like 3 weeks left, but It's a good question. Right now, if there is going to be a clean sweep, it looks like it's going to be Republican, that they'll take the House and the Senate. I still think push against the wall, the Senate will revert, will flip actually to the Republicans. The House will go to the Democrats. Now, let me just tell you, Maggie, if that doesn't happen and we get a clean sweep. So right now, I think the odds of a clean sweep by the Republicans higher than a clean sweep by the Democrats. Well, we get a clean sweep by the Republicans, I will very quickly pull the plug on my bond call. Like right now, I'm a nervous bull on bonds, but I will just have to take the bull out of that title because it's not just the fact that I'm not so concerned. I mean, I think we'll get it will be a one-time inflation shock if he goes through with his tariffs.
So,
And
wait, so that this is
but
also then
but it
talking
won't
about the
be.
presidency as well. Then,
Yeah,
are
well,
you
yeah, well,
saying Republican
well,
House,
if,
Congress,
yeah, I'm
and
talking. Well,
Trump?
I thought when you said clean sweep,
Right. Okay. So,
I thought you meant
right.
executive and legislative. Look, if Harris wins and split Congress, it's going to be tough to get anything through. It's including her goodies. If Trump wins, I mean, there's stuff you can do executive order, but the big stuff has to
Around the
get
margins. Yeah.
the House, the spending bills come out of the House, approved by the Senate, signed by the president, but has to get through the congressional process. We saw what happened. You go back to Barack Obama's first 2 years, and he has control. He gets Obamacare through. But you see what happened the rest of his presidency when there's split government, nothing's going on, and there's fiscal gridlock.
Mhm.
If you're a bond bull, I'm a bond bull. Fiscal gridlock is good for me. You go to, you go to Trump's first 2 years, right? Trump's first 2 years, carte blanche, tax cuts. It was a horrible time to be a bond bull, 2016 to 2018, and then the Fed starts tightening. But then when he relinquished control of the House and the Senate, nothing's going on, and bond yields come back down. So a lot rides. I have to say a lot rides. I don't ever really like to tie politics to my market calls because usually, especially at the beginning, what you see isn't always what you get. However, if the Republicans sweep, I'm going to have to pull the plug on my bond call. I've told all my investors that, like this is, and it's only 3 weeks away. And calling politics, especially in a tight race like this, I mean, who knows? But I do know that it's not just that about the deficit implications. I'm not talking about that. I'm talking about that his policies actually, despite all the other academic economists, we ran our own models and there's tremendous powerful multiplier impacts from his corporate tax rate cuts that'll filter through into employment and the economy. That's a big plank. That'll stimulate the economy. It certainly will stimulate the stock market. And usually you want to have bonds in the portfolio as a ballast diversifier in case something goes wrong in the stock market. Well, if Trump wins, I don't think anything's going wrong with the stock market if Trump wins. And then on top of that, if he goes through with his tariffs, and we never know how much of that is just a threat, but he believes in tariffs. He believes in tariffs as industrial policy. Now, it's not inflationary in a classic sense, but it'll be because tariffs would have to go up 10, 20% every single year for it to be truly inflationary. But it'll be a one time inflation shock, okay? And it'll cause a lot of people in the market to talk about inflation. So if he gets everything he wants, the Republicans get a clean sweep. My bond call is in big trouble. And it's not so much, yeah, it's more because of the impact it'll have on the economy and on the stock market. And I think the bond market will have trouble with that.
Yeah. What about that inflation though? You're saying it's an inflationary shock. Is there
Temporary,
any, it's
temporary.
temporary. I was going to say that it doesn't
No,
seem
it's a
like
one
it would
time.
be.
Well, this is what people don't quite understand. It's a one time level shift. It's a one time level shift. It's not like in the 1970s, OPEC was like doubling oil prices every 2 years. That was just, he's not going to raise tariffs every single year.
Can we, is there any concern that would turn into a protracted sort of economic war with China? Can we afford that when they are the
Well,
supplier?
if it was just China, then I don't care. He did that when he was president, but his tariff increase pledge is beyond. It's pretty well global. It's not just China, and that's where it become
But
more.
why wouldn't that be more long lasting? Because it would make the cost of everything here more
Well,
expensive.
if you go look at if people want to look at if you want to take America is the consumer of the world. Okay, we're running huge current account deficits. We are the buyer of last resort. So you want to try and play tit for tat with Trump, good luck. I wouldn't recommend you do that. If we had a trade war like that, which we didn't have in the last presidency,
Hmm.
what he's threatening to do now is bigger and broader. But I think that I don't think that you'd want to take him on. Okay, I think what you try to do diplomatically is try and maybe um, talk him out of it or talk to his officials to try and talk him out of it? Or what can we give in return?
Mm.
I wouldn't be betting on a prolonged or protracted trade war because the U.S. is a large closed economy. The rest of the world depends on the U.S. consumer more than the U.S. economy depends on the foreign consumer. So
Hmm.
the U.S. has an advantage in that
There's
regard.
leverage, right?
Yeah,
For this? So, I mean, this sounds like it's very important. This election, if you're willing to drop the bond trade and pivot, and if you're thinking it's going to be beneficial to stocks, is it all stocks, or do we see this heavy concentration back into those? The Mag 7, the winners. I mean, we had Druckenmiller even admitting he sold Nvidia too early. It just seems like that is such a magnet when we get those flows into stocks. Or do you think it would be broader, more broad based?
I think that I look. I think he would be. I don't know so much about the Mag Seven, given their valuations. However, for the tech sector, it would be positive. I mean, look who his principal fundraiser and advisor is right now is
Out on the trailers.
Elon Musk, right? Exactly. So I think that I would argue for technology stocks, Trump is positive. For industrial stocks, Trump is positive. For energy stocks, he wants to bring energy prices down. People, drill, baby, drill. Energy stocks were not the best place to be under his presidency. But industrials, broadly speaking, technology, yes. I would say I would shy away from the retail sector because when you're thinking about tariffs, they're going to take it on their cost of goods sold, and I think there's going to be downward pressure on margins from this tariff policy.
Mm.
So retailers, not so much, but many other parts of the market will benefit. Certainly, there's going to be a big offset from the fact if he can, and cutting top corporate tax rates to 15% takes you back to where it was. People don't realize that's where we were before World War II. That's where
Mm.
we were before we fought the Great Depression in the 30s and World War II. We just like most governments take spending up to fight COVID. Spending never comes down. Okay, it's always temporary. Raise tax rates to fight something, they never come down. Remember, those top marginal rates didn't come down till 1986 under Ronald Reagan. Think about how long it took to get Depression era World War II top marginal rates for individuals and corporations. Think about that for a second. How
Mm.
long? So all he's doing is taking corporate tax rates back to where they were just over a century, say roughly a century ago. But that's going to
Will that fuel
that's
enough
going to be
growth to
beneficial.
offset the debt?
Huh?
Will that fuel enough growth to offset the debt
No,
concerns?
no, no. There's I mean that was it's nice to talk about the Laffer curve. The Laffer curve worked, back in the early 80s when the debt GDP ratio was like 30 to 40%. We're like 130% right now. We're on the wrong side of the Laffer curve.
Mm.
So no, it's and the reality is that despite all the pledges to bring the deficit down, it never really happened under Trump's previous legacy. That is not something I would give him a
Well,
10.
there's been nobody working on bringing the debt down on
Nobody.
either side of it
It's
that I could
become.
find in
It's
the
become.
last.
It's become. These deficits and debts have become institutionalized, and frankly, I guess we did work on it. I mean, I say like you only know who rings the alarm bell at the peak of a fiscal crisis, and then we have to layer on the fact that the U.S. is the reserve currency and there's different attributes. So the U.S. has a longer fuse than other countries. However, when I look at Canada and I look at what was the trigger point, it's like sometimes you have to take a look at a balance sheet and income statement and a government like you do as a corporation. Although governments have taxing power, corporations don't. However, I always look at the interest coverage ratio. I always look at, how much of your debt servicing, how much of your revenue base is being absorbed by debt service. You get to 30% and cross it, that's when a lot of funky stuff tends to happen. And I've looked at the history of this across different countries. Now, we're not there yet, but we've crossed 20%. And we might just be a couple of years away. I know people say a couple of years away. Don't bother me about it. But to me, a couple of years away, when you think about it, it's like almost around the corner.
Yeah.
I mean, think of COVID. COVID is not some distant memory to me, but when you think about it, it was like over 4 years ago. So there's going to be a day of reckoning. And people will say, well, there's just scaremongering. But let's face facts. Richard Nixon hired Herb Stein to be his chief economic advisor. And maybe, outside of Kissinger, Secretary of State, he had good people around him. Herb Stein famously said, anything that can't last forever won't. So, but I do think we're on a slippery slope. But I think that if we're going to take it a year at a time, I don't think there's going to be a crash and burn in the coming year. I hope there isn't. I don't think there's going to be, but we're just a few years away under the current trajectory of getting the interest coverage ratio, the interest expense ratio, I should call it, above 30%. That'll be problematic. That'll be things that people will be talking about when it happens, if it happens. We're on a track where it's going to happen in the next few years. But the way I look at Trump is very pro-growth, very pro-growth. And it's true, fiscal expansionary, but it's more that he's very pro-growth. Mm-hmm. What does that mean? It means the Fed probably just has a prolonged pause. Everything is going to be pro-growth under Trump and really aimed at fueling a bigger stock market bubble than we already have.
And do you think there's a negative?
I'm just going to say that the problem for me, Maggie, is that there's no more important determinant of bond yields than the direction of Fed policy, which is also hitched to inflation, core inflation. But this is why everything that happened, going from 360 to 4% plus in the 10-year, had nothing to do with fiscal policy. All had to do with recalibration of market views on what the Fed's going to do. I'm going to tell you, if the Fed decides to pause, let's just say the Fed decides to pause, we are done. And you look at the fact that the market still has a lot of easing priced in, even now. We're going back to 5% of the 10-year note. I hate to say it. I almost choke when I say it. It's like telling an equity investor the S&P is going to 4,000. Think about that for a second. That's a heart attack for a bond investor. But I'm saying that's what's riding on this. What's riding on this is the Fed's reaction function. Remember what happened in 2018. Remember 2018, the Fed's reaction function to those tax. So tell me, what mattered more for the stock market in 2018? Actually, he passed the tax cuts in 2017 at the end of the year. It was a rough year for the stock market. Now I say that this should be bullish for the stock market, and I should caveat that if the Fed does not cut rates, or if the Fed raises rates, that's a much bigger deal, especially at the multiple levels we have right now. So remember what happened in 2018 after the corporate tax cuts. Stocks had a bad year, especially a bad fourth quarter. I think the S&P was down 20% in the fourth quarter. Credit spreads widened out dramatically, but the bond market got crushed, only to have a spectacular 2019. Why? Because the Fed started cutting rates. So in some sense, a lot of it comes down to everything we're talking about, but what overrides it all is the Fed's reaction function. Now, especially because we still have quite a bit of easing priced in. That gets priced out, and that's what I'm telling my clients, that, I sort of feel like Powell did on inflation at the beginning of the year. I'm pretty sure inflation will come down, but I've lost a little bit of confidence. And I feel that about my bond forecast right now. Mm-hmm. And so I'm not throwing in the towel, but, I've taken it out of the linen closet.
Yeah, it depends. I like that. It depends on who wins, and it depends, you're very importantly saying what happens to the Fed. Because if the Fed stops and the bond market 10-year goes back to 5 because the Fed's no longer easing, that'll temper any Trump rally. Am I hearing you correctly?
Big time, big time. We have to understand what happens then. Like, what happens? Think about that for a second. What happens if you go to 5%? Like right now, we have a forward PE of 22. Ergo, the earnings yield on the S&P is 4.5%. We go to 5% of the 10-year. Under the current backdrop, the equity risk premium goes to negative 50 basis points. So yeah, I think that would. So that's that, and you're 100% right. Well, I said it was bullish for equities, and that will be the initial reaction. I think the stock market will definitely love a Trump victory if he winner take all. Look what happened in 2016. Now the difference is that in 2017. under Janet Yellen, not much happened on rates. 2018, different story, but 2018 followed the big bazooka, which was the passage in the House and the Senate of those corporate tax
Mm.
rate uh, declines. So it could be a delayed reaction, but
Yeah, so it
I
sounds like big rally, but be nimble, because if we see a change in rates, that could turn around quickly, especially if you see
well,
yields start
it's
moving.
going to be a lot. What you want to do as an equity investor is probably play the options market. You know, where maybe the first half of the year next year is uh, is a good year, and then if a lot of the stuff goes through the system and
Mm.
bond yields back up and the Fed's doesn't cut rates, the stock market's going to have a rougher second half of the year.
Do we see a sell-off? Do we see the opposite reaction if there's a Harris win, that we see negative reaction in the markets, in stock market? Are you as worried about that, or it's just more the upside
I think
for
that
Trump,
I mean, look, there's a lot of stimulus in her package too.
which
Um,
would have to get passed?
right. And she doesn't have tariffs, but tariffs to me aren't that big of a deal. I'll have to probably go back like I did when he had tariffs in his first term and just explain that firstly, the inflation flow through is limited because you have to make a lot of guesswork as to who's
Yeah.
going to eat it, who's
Yeah,
going to
but
share it. The producers, the
If Harris
producer,
can't get a package through, then it's just kind of business. It's just gridlock as
yes.
usual, isn't
Well,
it?
it's the same as was the same with Trump. I mean, it's the same with Trump. I mean, there's stuff you can do through executive order, but you know, when it comes to the tariffs, the producer eats it, the retailer eats it. How much gets passed to the consumer is unknown. I think that people who talk about the inflation from tariffs, it's a very loose correlation. He embarked on tariffs from 2016 to 2020, and you look at the data, it's barely perceptible. In fact, inflation and core inflation finished his term lower than when he started. So go
Mm.
figure. Inflation is a lot more complicated to forecast than just tariff policy, okay? Especially when so much of it is services and not goods. Harris win, less bearish for bonds, maybe bullish for bonds because she's going to raise taxes on risk taking. So she's going to raise taxes on capital. I think the stock market will not like her victory. And so, insofar as bonds are inversely correlated to stocks, the bond market would do better under her presidency. Again, what I'm banking on and what I'm hoping for, actually, no matter who wins, is split government. Because when they say gridlock is good if you're a bond bull. So
David, you
that's what I'm
sound
banking on.
yeah. It's funny. You sound very contemplative, and it seems like there's a lot of uncertainty I'm hearing from you.
Well, it's a like I said, I feel I've had this feeling before, and I don't know if you want to call it self doubt. I guess you could call it that, but self doubt, but not yet at the point where I'm throwing in the towel. I'm at the point where, and if you read my dailies, you'll see that the probability curves around what I'm seeing down the road, those are shifting. They are not where they were. My base case and the, as you said, uncertainty or confidence interval around that base case, not what it was 3, 6, or 12 months ago. But the benefit of experience and doing this a long time is learning to being disciplined, having resolve, and not being impatient or tempestuous. Because I've had this before. And like I said, in 1989 and in 1990, it was the same thing. I was called a Luddite back in 1999 into 2000. And the recession didn't come until March of '01. But I was pounding my fist on the table at Merrill Canada at the time.
Yeah.
Took a long time. And then, of course, back in '06, the recession didn't start until December of '07. Maggie, I was pounding my fist on the table for almost 2 years. And that's what people have to know about me is that I do like to think that I'm thoughtful.
Hmm.
I like to make sure that people stay out of trouble.
I think
But
this
but
is
but but I'm
important.
really I'm really to a fault. So I I have to say that my biggest dilemma is rectifying the incoming monthly data, which year over year, like we started off, a lot of flatness, a lot of negatives. We 3% real GDP being fueled by government sector and all the multiplier impacts attached to that. The drop in the savings rate, which to me is a low quality way to stimulate consumer spending. But like I said before, if you're going to ask me what is the tail risk? The tail risk is the stock market, Maggie. I mean, firstly, I don't expect if we're right on split government, there'll be no fiscal stimulus next year. All this stuff, all these pledges to do this or that down payment, all this stuff by both candidates is would have been a waste of time to do any analysis on. Okay,
Hmm.
that'll fall by the wayside. Well, that is my bet. That is my assumption. And maybe it's false hope, but one party rule for either candidate, well, could be problematic, especially a Trump win with the House and the Senate really complicates my bond call. There's no doubt about it, and I will be revising that if that happens. Not
Hmm.
forever, but certainly for next year. Uh, and but everything comes down to the stock market, Maggie. Everything comes down to the stock market because that is, we have employment, sure, wages, sure. We know looking at the income strata of the economy, like why is it if things are so great, why is Trump ahead on the economy in the polling? Why? It's like what Brett Barris asked Kamala Harris. Like, why is it that he's so ahead in the economy if things are so great? Because we look at all these numbers in the aggregate and we look at averages, but for a lot of people, things are not good at all. For a lot of people, we're actually in a recession, and that's maybe
Hmm.
where the beast book came into it. But the high rollers, they're spending. The top 20%, they're spending because they're seeing their 401ks going through the moon. So the equity wealth effect on spending, alongside government spending, I actually think that's your growth story. You asked before about the composition. That's your growth story. The question is, how sustainable is that? Is government a sustainable model in what's supposed to be a capitalist free enterprise society? How did America turn into Europe? How did that happen? And the equity market, and what makes me unnerved about the equity market, sentiment is off the charts, right? Everybody is all in at a 22 multiple. What, Maggie, when I'm looking at price to sales, price to earnings, price to book, the Schiller PE, we're talking about 1.5 to 2 standard deviation events. This is the stock market when you look at all the valuation metrics, okay, has only been this overvalued two other times in the past century. You know when? 1929 and 1999.
We
And
know what happened.
well, the thing is, I go back to Herb Stein. Anything that can last forever, by definition, won't. These, I will never ever advocate. Now, I'm not 0% weighted in equities. I got a 20% stake in the equity market. I don't believe in 0 or 100, but I'm back to where I was in the fall of 2007. People say valuations only matter when they matter, but by the time they do matter, you're 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 in a trap door. You're going down the shaft. So
So
I'm
is the rest bonds, or what do you think about cash and things like gold or
I like
commodities?
gold. I look at gold. Gold is a great look as these debts. I mean, what did I see in the Financial Times? I mentioned today what the global public sector debt is heading towards $100 trillion. Hello, 100 trillion. I mean, it's crazy. I think that gold. You see, at some point next recession, there'll be more QE. There'll be tremendous instability. We go into a bear market in equities, there will be tremendous social instability. And I'll tell you why in a second. Gold is a hedge against instability. There's a whole bunch of other reasons. I don't know. People talk, the global central banks are buying more gold. Okay, fine. That's nice to know. That's the cherry on the cake. I think gold is just a ballast, like bonds in the portfolio. It doesn't earn you a coupon, but when and if the equity market goes down, you'll be happy you had gold in there as a stabilizer. It's a diversifier. I believe in diversification. But here's the problem, Maggie. Most people don't believe in diversification. Do you know that when you look at the Fed flow of funds data, the household sector is over 70% weighted in equities, only 8% in bonds, the rest in cash. That's unprecedented. The baby boomers, right? People over the age of 60 that should have 30 to 40%. No, I'm at 20. I won't tell you my age, but I sort of fit that mold. Should be 30 to 40%. They're at 60%. So we have a very, even though the market quote has broadened out, we still have the highest concentration of the top 50 stocks in the S&P. Technology is a share of the charts still look much like the late 1990s. Concentration risk, but not just that, concentration risk in the household balance sheet. That's why we see when you have such concentration and everything is great and it's Goldilocks and things are going up and you're seeing your monthly 401 statement, you're going to spend more money and take your savings rate. You're not going to have to worry about your current income. You're going to spend your current income because you got this pot of gold at the end of the rainbow. People are
Which is
very
paper. It's on paper.
people are very confident over their ability today, their ability to fund their retirement lifestyle because of what the stock market has done. It used to be when I went to school in the 80s, the stock market was a vehicle for companies to fund capital spending. You could, use the debt market or the equity market. Now it's become a source of wealth creation.
Mm-hmm.
But look, we're at the extreme bands of valuation. Equity risk premium at 40 basis points. Like I'm looking at this, and people say, but you're not in the equity market. Are you crazy? And I say, well, I know it sounds crazy because I missed out so much on this rally, but I have to protect my family. And I simply will refuse as an equity investor, which has capital risk. When you look at the equity risk premium, it's telling you that as an equity investor, you are paying to take on risk as opposed to getting compensated to take on risk. And that makes no sense to me. But you see, the clown at the circus keeps on blowing up the balloon, and the balloon gets bigger. And I've got my Bloomberg terminal, and I got my TV screen. I'm watching the balloon get bigger every day. But that's what it is. It's a momentum casino. It's a balloon. I'm really nervous, and there's more at stake. See, the thing is that, Maggie, nobody has rebalanced their portfolio this cycle. Nobody has diversified. Nobody's taken profits. Everybody is all in. They are all in. Mm. And so because of this concentration risk, and the household sector in the United States has never been this exposed to risk on the balance sheet like they are today. Ergo, a bear market in equities. And we're going to have a bear market at some point. I don't know when. You can say, well, Rosenberg, you're saying this time last year. I understand that. But everything moves in cycles. The next bear market, whenever it happens, the implications on the consumer and the economy are going to be humongous. The impact it's going to have is going to be huge. If we rewind this movie, we run it backwards, and we mean revert the savings rate. You do the arithmetic on mean reverting the savings rate for where it is today, and we're going to have an ugly consumer recession. I just don't know the timing. And yes, I've been frustrated because my calls haven't worked out. Yeah, but I've been here before, and I'm still focused on the big picture. And that's why I can't part with my bond call even entirely, even if Trump gets elected, because if we go into a huge corrective phase in the stock market, there is going to be a natural flight to quality and safety into the bond market. So when I say I'll pull the plug on the bond market, it's because I know how investors are going to react to a Trump clean sweep. Mm-hmm. But I might not stay. I might just turn neutral. Neutral to me on treasuries is like bearish for everybody else. Maybe I'll throw Lacey Hunt and and Gary Schilling in there. Like basically neutral for us is like, oh my God, they're bearish. But that's right. Like if you adjusted historically, you're 100% right. So I'll probably just pull the plug on my bullish call, but I doubt that because at some point when this thing cracks, and it's going to crack, and I wouldn't say this ordinarily, it's only because the impact it's going to have on the economy is going to be bigger than it's ever been in the past. So I'm going to want to be there. I think that I want to be in the treasury market when that happens. Of course, not knowing when it's going to happen, but I want to be there because it is going to be rather spectacular. I'll tell you this much. I've done the work, went back, 1929 bubble. Nobody thought, look, if you interviewed me, if I was still alive in, say, 1929, and you'd say, Rosenberg, we just had Irving Fisher on our call. And he said stock market is at a permanently high plateau after years of and the market's more overvalued now, Maggie, than it was back in 1929, okay? And look what happened next. I went back to 1929, went back to that was a margin debt bubble, and then the Nifty 50 in the early 70s, and the commodity oil bubble in the late 1970s, and then the commercial real estate LBO bubble, the late 1980s, and the tech bubble, late 1990s, and then the housing subprime bubble back in 2006, 2007. When the bubble breaks, do you know how far down bond yields go when the bubble breaks? 300 basis points. 300 basis points. And you say that to people today, but they see, the thing is that most people don't think we're in a bubble, even though I think a 2-standard deviation event classifies as a price bubble. I think that when we have a year like we did, where earnings are up 5, 6, 7%, but the stock market's up 35%. So the price action is going 6x benchmarked against earnings. That's a pretty big bubble. Stuff that's only, so in any event.
Why do you feel like the recession would be worse than anything we've seen before? Because so many people
it'll be huge because there's more at stake, because even baby boomers, even pension people that have no business having that, people that have 30% traditionally equity exposure in their financial asset mix are 60%. And the overall household sector, and remember, there are people that own no equity, right? Like the low end of the spectrum, they don't own equity. They live paycheck to paycheck. So this is aggregate numbers. People that actually are equity owners, probably that number's a lot higher. But for the proletariat, for the household sector in general, 70% asset mix in equities is unprecedented. Moreover, at a 22 multiple, at a 40 basis point equity risk premium. You see what's happened here. It's this bull market, and actually the bull market and bubble is in one specific tranche of the equity market, which is passive index investing.
Yeah.
Which is now it's now more than 50% of the market cap. When John Bogle first unveiled this back in the mid-1970s, he said this market, and he was the pioneer, Vanguard, this market will never get above 20% of the market cap. It's over 50%, on its way to 60%. So people are investing blindly.
They're getting retail investor into it.
Then these ETFs, they have to buy the market, and so that's why the clown of the circus, the bubble gets bigger. The bubble gets bigger. They have to put the money to work in the market, to the point now where passive investing. What is passive investing, Maggie? It means I'm going to invest, but I don't have to do any homework. I'm not investing with a fund manager who will do the homework for me because they're trained. Not that they always get the call right, but they do homework. That's what they get paid to do. I will ignore valuation. I will ignore balance sheets. I will ignore income statements. I think it's a very dangerous situation. Does anybody really talk about it? Over half the market is passive, which means that you have over half the market. People are just basically playing pin the tail on the donkey. What happens if you have a loss of confidence for whatever reason? I don't know if it's geopolitics, domestic politics. I don't know what it is. Maybe you're right. Maybe it's fiscal policy. What happens when there's a loss of confidence? What happens if people say, you know what, I want to get out. I want to get out. Then it's going to cause this cascading negative fund flow impact.
Yeah.
Now, the fact it hasn't happened yet is the rationale people use for why it will never happen. And I'm going to tell you something that scares the you know what out. But I would say that this market that everybody fawns over, I'm sure you interview people that are just like, and they've been right. They've been right. But I don't think, and I don't want to be arrogant when I say this, I don't think they understand that there's less stability to this bull market than meets the eye.
What do you think? I mean, this is a fantastic point, David, and I think one that, does concern some people, although not enough people are talking about it, especially people who actually are participating in it. What do you think is a good thing for people to ask there? Usually there's 401 is someone's overseeing it, or maybe they listen to this and they get concerned that they're more exposed than they should be. What's a good question that they should ask a financial advisor to try to figure out whether their exposures were right? What would you tell them to ask?
I mean, it never changes. It's basically, based on my age, based on my goals and my risk tolerance. All three are important. Do I have an asset mix? Do I have an asset mix that represents those three things? Age and your income and your financial goals, your tolerance for risk. And then within your equity portfolio, what is the beta of that portfolio? Because not all equity portfolios are the same. I used to say before utilities got caught up in the AI craze, how utilities were bonds and drag.
Yeah.
By the way, I'm still bullish on utilities. So, but there's
So what are you actually holding? If you
well, no,
within
I
that
would say,
stock? No, but within
you want to be mindful of the cyclicality in the portfolio. And by the way, I'm not saying 0 or 100. I don't believe in 0 or 100. Okay, I don't believe you put all your eggs in one basket, and I don't believe that is 0 or 100. I do believe in diversification. And so that's why I will never abandon bonds. Gold is a ballast. Golds and bonds have safety characteristics. People say to me, even during that god-awful cyclical bear market that we had in treasuries in 2022 and 2023, so you got to understand why you want to have treasuries. Now, keep in mind that only 8% of the household asset mix is in bonds. Bonds have security of payment characteristics. Treasuries, not corporate bonds, because they have callable risk and there's default risk. The U.S. government's not going to default, despite everything we talked about. That's impossible, because so much of these bonds are held by pension funds. So if you want to have another civil war, have the U.S. government default. It's not going to happen. So you've got guaranteed payment assurance in treasuries that don't exist with any other asset class. That's what makes them special. And you buy a 5-year treasury note, 10-year long bond, you know what you're getting paid at the end of the maturity. Stocks don't have a maturity, okay? So bonds have particular intrinsic characteristics. That's why you want to own them, but nobody wants to own them because they're not going to make you rich. They're just going to help
prevent you from being poor.
They're going to help you not get destroyed. And so, but within the equity market, look, I've been saying this for the past few years. Healthcare, pharma and med tech, pack that away. I have liked utilities. They've been re-rated as defensive growth because of the power boom.
Mm-hmm.
Actually, although I've been not bullish on equities one iota, the sector calls have been pretty good. I admittedly didn't have enough exposure, but I don't quite overspill milk, and I want to sleep at night. Healthcare, utilities, consumer staples. One stock that you should have in your portfolio. I'm not a stock picker, okay? But I've written about this for cycles. With the one stock that doesn't go down in recessions, or you know what it is? Walmart.
That's what I was going to guess that, but I wasn't sure.
Yeah. So in any event, and look, I think that because I'm a long-term bond bull, you'd say, well, but you should if you like duration in bonds, you should like duration in stocks. And I got no problem with the Mag 7. I mean, there's companies like, you look at a Microsoft. Microsoft, it's interesting, when you look at 10-year cycles, now they went public in 1986. Microsoft is always right up there near the top over 10-year CAGRs, 10-year annualized growth rates of total return. Microsoft is always up there. You could almost argue that companies like Microsoft, or Alphabet. There's there's utility-like characteristics in some
Hmm.
of these Mag 7, not all. Like I wouldn't say Facebook has utility characteristics or Netflix has utility characteristics, but you could argue that Google and Amazon and Microsoft do.
Right.
So I'm not like people say, "Whoa, see a big bad bear." No, like actually not. But those are the areas. Those are there will be a time when I will be once the valuations mean revert and bond yields go down sufficiently. I'll be probably advocating tech stocks. I'm a big fan of the tech companies, not a big fan of their stocks. The ones I mentioned, though, have utility-like characteristics. So if you told me that you own Microsoft, I would say, well, that's fine.
Yeah.
I'm not zero weighted in equities, but I'd say that things that you can find that have utility-like characteristics, and that includes utilities themselves, consumer staples, very defensive, healthcare, defense. So I like the defensive growth. I don't like the cyclicals. I'm not getting into material stocks. I'm not getting into industrial stocks except for one sector,
What's that?
aerospace defense, because military budgets are going up everywhere in the world, and that has visibility,
Yeah.
and they're not trading at crazy multiples.
Kind
So
of sad
there's
statement of where we're at, but
there's slices of the market that I do like. Okay, it's just that it won't bring me to 70% of my asset mix being in the S&P 500. Okay.
for all the reasons you said. David, we covered a lot of ground. This has been a fantastic conversation, and you always say that you're not a perma anything, and I know people joke with you about that, but I think this conversation today really underscored that, because you're looking at things in real time, you're adjusting your position, and you're leaving your mind open to what may happen in a really uncertain environment. And I think that's a testament, not only to you but all of your experience.
Well, thank you for acknowledging that. There can't be. You see, by definition, there can't be a perma, uh, because things change. To be a
They
perma
do.
anything, perma bull, perma bear, perma anything, you're making a very bad assumption that things stay constant, which we know,
Exactly.
especially in our business, that they
It's
don't.
certainly not the case over the next few months. And a really, really excellent warning to people about really thinking about your position sizes and the diversification of your portfolio. We can't talk about that enough, I think, especially as more and more people sort of, age into really needing that money in retirement. David, thank you so much. I hope you'll come back again. Let's talk around the election or right after it, so we can see how to navigate through. We'll have a little bit more visibility then.
Thanks a lot, Maggie. I'll see you soon, and thanks for having me on.